Bitcoin plunged over the weekend to lows that many analysts didn't expect. And there was a big catalyst that really caused this to happen. We're going to take a look at what exactly happened. We're going to look at this transformation that's happening underneath the surface we can see on on-chain analytics. We're going to look at our great Uncle Warren Buffett to see the sage wisdom we can gain from him and figure out exactly what's going on with Bitcoin. So let's go. All right, so real quickly, if you've not been paying attention to Bitcoin, then I guess I'll catch you up real quick. And if you were, then you know that it was pretty much a bloodbath over the weekend. We saw Bitcoin drop to levels that a lot of analysts didn't expect to happen. Now, sure, there's plenty of voices shouting in the wind saying that it's going to drop to 10,000 or 3,000 or 0 or whatever. They don't have any math to back any of that up. But we have lots of support levels that we can look at and see where Bitcoin historically has been sitting. And right now it's about this 20,000 level where it's at today. But it did drop down below that over the weekend in a very thinly traded market. So what exactly happened? We can see right here, it says Canada's Purpose Bitcoin ETF liquidated 50% of its holdings overnight. All right, so we can see right here, Canada's Purpose ETF is the world's first actively managed crypto ETF. It sold 50% of its Bitcoin holdings overnight. It was 24,500 Bitcoin on June 17th, 2022, and it drove the price down to a low of 17,600. Now, what we can see here, Arthur Hayes, the former BitMEX CEO, commented on this whole move, and he says, "It smells like a forced seller triggered a run on stops. Given the poor risk management by crypto lenders and over-generous lending terms, more pockets of forced selling of Bitcoin and Ethereum." So a couple things to unpack from here. First of all, in illiquid markets, you can drive the valuations down pretty quickly. Simple, supply and demand, the two words I use all the time. So if there's not enough buyers and you want to dump a lot of Bitcoin, you're gonna push the price down. Typically, big moves like this are done OTC, over the counter, so they're not done on liquid exchanges. If you really wanted to move a lot of this Bitcoin at one time, or typically you do it over a period of time because it creates something known as slippage. So they started selling some of the Bitcoin at 20,000. By the time they were done, they're selling their Bitcoin for 17,000. So they were losing $3,000 per Bitcoin they were selling because they had pushed the price down due to the slippage. So when you're selling 24,000 of them, losing $3,000 per Bitcoin, you lose a lot of money. So typically you do this over a long period of time to reduce that slippage, or you do it over the counter. They didn't. As a matter of fact, they did it overnight on a weekend in a very thinly traded market. So was this intentional? Or was it done on accident? Well, we don't really know the answer to that. I'm guessing it was probably intentional. And per the point that is made here, it was done by forced sellers. Now, in investing, I don't care what asset you're looking at, whether it's real estate or gold or stocks or cryptocurrencies, you never want to be a forced seller. Why would you be a forced seller? Well, what's happening right now is all this leverage that's been built up in the system. We talked about it with Terra Luna. All this leverage that they had, and then it's now causing a domino effect. We're seeing other lenders going down. We saw Celsius, we talked about that last week, them going down. Their margin calls, because of the leverage they have built up, are now bringing down other bigger funds like Three Arrows Capital, for example. Now it looks like BlockFi is potentially on the ropes, and it's just a bigger domino effect. And probably Canada's Purpose ETF was also a forced seller. They probably had margin requirements, and they were forced to sell. That's the only reason you can think of that they would sell that amount of Bitcoin at that point in time. So they probably had big leverage positions open. The price of Bitcoin came down to a point they had a margin call. They had to either post more collateral or risk getting liquidated. They probably couldn't post the collateral, and they were liquidated, which caused that massive sell to go down. You can see it on this chart here graphically. You can see the amount of Bitcoin that went down. Now, unfortunately, as Hayes continues on here, he says that the crypto community, the cryptocurrency lenders' poor state of risk management could result in more pockets of forced selling of Bitcoin and Ethereum. Beware of the forced seller. And also, like I said, you never want to be a forced seller. So how do you not become a forced seller? Well, whether it's in real estate, for example, are you buying more house than you can afford? Are you in an adjustable rate mortgage that could adjust up where you couldn't afford it? If so, you could be a forced seller. And it's the same with any other asset. Have you leveraged your Bitcoin or your stock positions where you may not be able to meet those margin requirements and will be forced to liquidate your positions? Now, this isn't all bad news, all right? Now, markets stop going down when there's no more sellers. All right, I talk about the opposite of that, which is markets stop going up when there's no more buyers. But markets stop going down when there's no more sellers. So we are starting to clear out all of these over-leveraged positions where investors, traders, whatever you want to call them, have taken on way too much risk, used way too much leverage, and now they're being forced out of their positions. And so it's a survival of the fittest. We are taking the money from the people who have mismanaged it, and we're giving it to people who can manage it better. We can see this playing out in real time. So good old Warren Buffett, he said that the stock markets, or we could just say the markets, are a device for transferring money from the inpatient to the patient. So most Bitcoin holders are long-term holders, and they're prepared to hold for 20 years or 50 years or 100 years. But then you have a lot of traders who came in and they wanted to make money really fast. They couldn't be patient, so they levered up and they went 2 times or 5 times or 10 times or 20 times or 50 times leverage on their positions. And because of that impatience, they're now being forced out of their positions, and now the long-term patient holders can acquire that. And that's exactly what we've seen happen. You can see right here, Bitcoin minted more than 13,000 new what we call whole coiners in the past 7 days. So a whole coiner is somebody who owns an entire Bitcoin. Now, news alert, if you don't know this, you don't have to buy an entire Bitcoin. You could buy $1 worth of Bitcoin or $5 or $10 or $20. So a lot of people I've been buying $20 a week of Bitcoin or $50 a week or $100 a week. And their goal is to get to one whole Bitcoin. That'd be like buying grams of gold or ounces of gold. And your goal would be to get to 1 bar, which is about 400 ounces of gold. And so these people have this dream of getting to a whole coin at some point. And we can see that more than 13,000 whole coiners were now minted in the last 7 days. So we can see here, we can see this by on-chain. The number of Bitcoin wallet addresses containing 1 Bitcoin or more increased by more than 13,000. The total number of whole coiners now surged to 865,000. Now, what's interesting about that is there will never be more than 21 million Bitcoin. There's more than 56 million millionaires in the world today. That means there's not even enough Bitcoin for all the millionaires to own even half of one. But as we can see here, there's 865,000 people, that almost 1 million people already own more than 1 Bitcoin. So there's not much left. That's a very scarce asset. And so we can see that all the inpatient traders who use that leverage are losing it to the patient people that are trying to stack that whole coin, and that's exactly what's happening. Now, if we look at a chart real quickly, we can look at this, and we have to zoom out to get this perspective on things, all right? What we can see is that we have back here in 2011, there was a 90% drawdown in Bitcoin. In 2013, we had a 76% drawdown. We had an 84% drawdown, an 84% drawdown here from 2017 to 2018. And here we are today at a 75% drawdown. It's certainly not fun watching an investment drop by 75%, but as we can see historically, every time it's dropped by 70 or 80%, it has been a tremendous buying opportunity. Now, anytime you're investing into something so new like Amazon, this is what happens. Amazon, I believe, has had 3 80% drawdowns throughout its history. Amazon has not died. It's continued to get bigger, and Bitcoin has not died. It's continued to get bigger after each one. People want to compare it to the famous Tulip Mania. The Tulip Mania busted one time. It never came back, much less coming back over and over and over. But maybe I'm wrong. We don't know the future, but I'd love to know what you think. Leave me a comment and let me know. Of course, if you're not subscribed to this channel, please click that subscribe button. I'm trying to grow it so more people get this information. Give me a thumbs up on this video if you like it. And if you don't, give me a thumbs down. That's okay, but leave me a comment. Tell me why. And that's what I got for you today, all right? To your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.